Guide to Benjamin Graham's and et al. The Intelligent Investor, the definitive book on value investing by Instaread. Please note this is a companion to the original book. Copyright 2015 by Instaread. All rights reserved worldwide. No part of this publication may be reproduced or transmitted in any form without the prior written consent of the publisher. Limit of liability, disclaimer of warranty. The publisher and author make no representations or warranties with respect to the accuracy or completeness of these contents and disclaim all warranties such as warranties of fitness for a particular purpose. The author or publisher is not liable for any damages whatsoever. The fact that an individual or organization is referred to in this document as a citation or source of information does not imply that the author or publisher endorses the information that the individual or organization provided. This concise companion is unofficial and is not authorized, approved, licensed, or endorsed by the original book's author or publisher. Table of Contents Overview. Important people. Key Insights. Analysis. Key Insight 1, Key Insight 2, Key Insight 3, Key Insight 4, Key Insight 5, Key Insight 6, Key Insight 7, Key Insight 8, Key Insight 9. Author's style. Author's perspective. Overview. The Intelligent Investor, the definitive book on value investing by Benjamin Graham, with commentary by Jason Zweig, is a thorough guide to the principles of portfolio creation, cost management, stock and bond picking, and stock ownership for the defensive, long-term investor. Investors should split their portfolio between bonds and stock. The level of risk an investor should take depends on how much time they have to devote to research and management. The recommended percent of the portfolio that can be spent on higher risk transactions should not exceed 10. Many people buy a stock when it has already started to rise above its best price and sell when it has already fallen below its peak. This cuts into profits, as do transaction fees, taxes, and advisor fees. To avoid buying a stock when it is already too expensive to offer a good, long-term return, investors should define their preferred price-to-average earnings ratio. In order to make as many purchases at optimal prices throughout the year as possible, investors should devote a set dollar amount to invest each month, which is called dollar cost averaging. Good strategies for investment include finding well-managed funds, getting advice or a qualified manager, reading deeply into the numbers of corporate financial statements, seeking stocks that demonstrate consistent dividend payments and asset value, and limiting risk by setting a price that will best guarantee results even if projections turn out to be overinflated. Investors should not fall for the hype, take recommendations without doing independent research, or think that past performance guarantees future growth. Important people. Benjamin Graham. Benjamin Graham was an investor and teacher at Columbia Business School. With fellow Columbia teacher, David Dodd, Graham developed a defensive investing strategy following the 1929 Wall Street crash, and went on to publish 6 books with several reprints. Jason Zweig. Jason Zweig writes for Money magazine. He has written several books based on conservative investing strategies, including books based on the writings of Benjamin Graham. Warren Buffett. Warren Buffett is one of the world's wealthiest people, CEO and chairman of Berkshire Hathaway, and a widely admired investor. Graham and Dodd's work influenced him deeply when he began investing. David Dodd. David Dodd was an instructor at Columbia Business School when he became a co-author of several books on value investing with Graham. He was also a partner in the hedge fund and investment trust founded by Graham. Key Insights. Value investing is a defensive investing strategy that concentrates on long-term investments, a portfolio balanced between bonds and stocks, and low risk. Strategies, such as dollar cost averaging, price-to-earnings ratios, and margins of safety, help investors set spending limits to minimize their losses. The modern stock market favors speculation over investing and includes a large population of emotional, impatient stock buyers. They tend to purchase a stock when it has already risen in value above its ideal price-to-earnings ratio, and sell it when it has already fallen from its highest price. Investors with little time or interest to devote to their portfolios should invest primarily in mutual fund shares or index funds. After thorough research, Investors may choose to have someone else manage their portfolios if no fund available offers the portfolio they want. Even aggressive investors should exercise caution when considering second-grade stocks, preferred stocks, foreign bonds, new issues, junk bonds, day trading, initial public offerings, convertible bonds, and call options. Past performance, predictions on industry growth, and projections have proven time and again not to guarantee growth in investments. Low-risk stock picking should screen out any company that does not meet the 7 criteria for a well-capitalized business with high-performing shares at low prices. Stock picking with a higher level of acceptable risk may consider companies that meet fewer of the criteria, as long as the prices are appropriate. Corporate accountants have many ways of manipulating figures for losses, taxes, and stock options to show an earnings per share increase where there was none. Investors should be certain to inform themselves of the context behind report numbers. Stockholders are part owners of businesses with the ability to change management through their proxy votes, as long as they communicate and organize in their interests. Companies sometimes try to talk them out of dividend payments, which is not in the investor's best interests. Analysis Key Insight 1 Value investing is a defensive investing strategy that concentrates on long-term investments, a portfolio balanced between bonds and stocks, and low risk. Analysis Value investing is a style of investing that focuses on long-term investments with a high probability of returns, rather than long shots that an investor hopes will demonstrate growth within a month or less. A value investor should only manage their portfolio a few times a year and should be disconnected from daily stock ticker prices. The value investor does not constantly seek out new investment opportunities or new share issues, particularly when those opportunities are untested. The frantic pace of traders on the stock market floor and the ever faster trading by digital connection are completely at odds with the value investing approach. It may be less glamorous, considering the reputations of traders who made their fortunes on the undervalued opportunity that they knew would be the next Google or Microsoft. However, the value investor is a person who seeks to make enough for their purposes, not the most money anyone ever made in a single stock transaction, so the glamour of day trading holds less appeal and the risk of losses is a greater deterrent. A day trader or a speculator may see the value investor's portfolio as too small and too limited in range to provide market-beating returns. Popular belief asserts that a portfolio should include a range of valuable stocks still on their way up, necessitating a large investment up front and the belief that none of those stocks are already near their peaks, or a selection of small companies' new issues or initial public offerings, to try to catch a future technology giant while it is still small. In reality, neither of those portfolios is likely to provide returns at all, since getting into any already valuable stock could mean being atop a market bubble when it bursts, and the vast majority of potential market giants in the making never live up to that potential. In comparison, value investing seeks the safe choices and still delivers substantial returns. Key insight 2 strategies such as dollar cost averaging, price-to-earnings ratios, and margins of safety help investors set spending limits to minimize their losses. Analysis The value investor uses a range of strategies, figures, and personal limits to guarantee the greatest potential returns, mostly to limit the investor's natural urge to tinker with the portfolio or take risks based on big promises. Dollar cost averaging is used to ensure investors do not spend too much on poor investment choices at any one moment. Instead of setting an amount to spend on stocks for the year and purchasing the best 30 options available on the first day, a value investor can split that amount into 12 equal amounts and spend that money each month on the top 3 or 4 options in that month. This guarantees that investors will never have to buy the stocks that are more expensive than they should be just because they will not get another chance. Some value investing strategies may seem mechanical enough to be programmed into a computer, requiring no input from the investors. The principles set numerous hard and fast rules about what price-to-earnings ratio is best for a purchase and how to set a margin of safety on a stock that offers significant returns, leaving out the need for intuition or first-hand knowledge about a business or industry. In one sense, This is a strength of value investing because human beings have been so notoriously wrong when attempting to predict the future. Setting rules about the permitted level of risk an investor may take with investments prevents anyone from trying to bend those rules for the sake of one particularly attractive opportunity. Also, while the strategies may seem unaccommodating for creativity or individual decisions, they really set people up to make those creative decisions in a better, informed way. Rather than believing an analyst on the news who names their favorite stock, the investor can do the original research free of conflicted interests, investigate the reality of the numbers, make predictions about the companies that fit the minimum standards of risk, and balance the portfolio between stocks and bonds depending on where the risk is. That gives plenty of room for human intuition to play a role and to identify the context clues that a computer would be less likely to see. Key insight 3. The modern stock market favors speculation over investing and includes a large population of emotional, impatient stock buyers. They tend to purchase a stock when it has already risen in value above its ideal price to earnings ratio, and sell it when it has already fallen from its highest price. Analysis. Every investor has heard that the key to success is to buy low and sell high. However, speculators who rely heavily on other investors' buying trends to make decisions will struggle to really meet that standard. They may decide which stock to buy when other people have already started buying it and pushed up the price. Similarly, a stockholder may not know it is time to let go of the stock until it has already hit a peak and other holders have sold their shares. These habits cut into the transaction's returns on either end, as do transaction fees and taxes. Value investing may seem least attractive to the speculator who enjoys the excitement of picking stocks and gambling on their success, but it is actually the approach that is the most reliably profitable. The stock market is often compared to other forms of gambling. Each investor is placing a bet on a company's success, through conventional share purchasing, or on its failure, by shorting the stock. In most cases, the highest dollar amount that an investor can lose is the amount they put down to make the purchase to begin with, and usually no one loses that entire dollar value when a stock falls in price. The same applies to most gambling transactions, such as slot machines. However, there are some stock market transactions that can put the investor deep in debt, such as the short sale that has potential for infinite losses. The casino offers no similarly risky gamble except when it begins offering credit to gamblers. Just like the casino, the stock market can appeal to a particular type of impulsive, reward-driven risk-taker. Removing the impulse from the transaction lowers the likelihood that someone will lose more than what they put into the bet. Key insight for investors with little time or interest to devote to their portfolios should invest primarily in mutual fund shares or index funds. After thorough research, investors may choose to have someone else manage their portfolios if no fund available offers the portfolio they want. Analysis. The amount of risk that an investor should be willing to take does not depend on their age, time until retirement, or personal preferences. Instead, the level of acceptable risk depends on how much time someone will spend doing the necessary research to ensure that a purchase is one that meets the value investing criteria. Anyone who enjoys that kind of research and has plenty of time to spend on it may take the highest, albeit still conservative, level of risk. People who do not have the time, or do not have the patience, may choose to outsource that research to others by purchasing shares of funds that have managers to do that work. They may also decide to hire a manager or consultant if no fund available offers the portfolio they desire. What the investor may not do, the value investing strategy implies, is settle for a less than thorough level of research when making a significant investment. The value investor is expected to either make a fully informed decision or no decision at all. That includes the decision of which fund to invest in or which manager to hire. The average fund investor is likely to be risk-averse, but not enough so to have thoroughly researched the fund's managers, their own holdings, whether the managers own shares of the fund, whether the promises they make are realistic, how different those investment positions are from other investment indexes, and the reasoning behind the positions. All of that information is supposed to be available to the investor, but as is the case also with legal documents, thick stacks of dense text rarely get the attention they require for informed decision making. The investor's due diligence is meant to evaluate whether the fund managers are doing their due diligence. Any investor who does not do that research may end up with a fund manager who is more interested in paying themselves than earning returns for clients and no way to get the money back for that investment. Someone who chooses a fund manager or hires a manager of any kind without making use of the value investing principles could be considered a speculator on the nature of the individuals entrusted to handle their money. Key insight 5. Even aggressive investors should exercise caution when considering second-grade stocks, preferred stocks, foreign bonds, new issues, junk bonds, day trading, initial public offerings, convertible bonds, and call options. Analysis. There is no shortage of investment opportunities available for people who seek a promise of reward without any guarantee of success. The value investor avoids any stock option that does not offer the best guarantees of dividend payments and payment in the event of liquidation, something second-grade and preferred stocks do not promise. They also steer clear of hype-driven choices, no matter how much of their portfolio has been dedicated to speculation. Initial public offerings and new issues attract such hype but usually do not offer good deals for buyers. Foreign bonds can represent too great a risk for the investor, although some developing economy funds mitigate the risk of an all-domestic portfolio. Day trading as a practice runs counter to the cautious, calculated approach of the value investor. While convertible bonds and call options can appear to offer some reduced risk to investors, in reality they have a similar level of risk with the addition of a cap on potential gains. The 2008 U.S. recession particularly demonstrates the potential outcome of a particularly risky financial instrument like junk bonds. The housing-led crash relied on the wide distribution and heavy reliance on bundled subprime mortgage debt, against which many financial institutions borrowed heavily. These firms believed that the housing market would continue to rise and buoy the value of that mortgage debt. However, when the market collapsed, housing prices fell even though mortgage holders still had their high levels of debt and no way to repay it. Many chose foreclosure to relieve the debt burden, and the mortgage holders were forced to accept low sales prices for homes previously mortgaged at higher levels. The subprime mortgage debt instruments lost value and banks that held them lost the ability to raise capital to cover their own debts, threatening their ability to meet obligations worldwide and necessitating bailouts to keep them afloat. A firm of value investors would not have staked so much on such a risky investment as home loans approved to people who barely qualified under lenient standards because the scale of risk was so enormous and the likelihood of returns did not outweigh that risk. Key insights 6. Past performance, predictions on industry growth, and projections have proven time and again not to guarantee growth in investments. Analysis. Analysts routinely offer guidance to investors about what growth levels in the future will be based only on their knowledge of past growth levels. However, because of the number of unforeseeable factors involved, analysts are generally far off in their estimates, failing to predict accurately whether a stock will see a net gain or loss in some cases. Any type of projection is similarly vulnerable to high degrees of error, including the predictions in the early 2000s that .com stocks were wise investments as the internet grew. Those predictions turned out to be incorrect when the .com bubble burst. Anyone can make a prediction about the future of the stock market, regardless of their actual understanding of it. That advice may be based on first-hand knowledge of a market, and a person may be able to definitively state that pens will be in high demand in the next 5 years, but stock bubbles of the past have demonstrated that an industry's success has not automatically resulted in stock success, and strong business in the pen industry may not mean strong returns in pen manufacturer stocks. Even the indicators recommended by the value investing strategy do not perfectly predict a stock's success. Stock strategies attempt to identify companies with strong past performance, but just because a pen company performed well in the past does not mean that a new craze for digital writers will not put a portion of the pen market out of business within the next few years. Key Insight 7 Low-risk stock picking should screen out any company that does not meet the 7 criteria for a well-capitalized business with high-performing shares at low prices. Stock picking with a higher level of acceptable risk may consider companies that meet fewer of the criteria as long as the prices are appropriate. Analysis: a good stock for a defensive investor to pick will meet 7 specific criteria. The first criteria is that the stock will be offered by a company with $100 million in annual sales, or not less than $50 million for a public utility. The company's assets should be at least double its liabilities and long-term debt not higher than its working capital. For a public utility, the debt should not be twice the stock equity. There should be earnings for the common stock in each of the last 10 years. Dividends should have been paid in each of the last 20 years. The company should show at least a 1/3 per share earnings increase on average when comparing the 3 years at the start and end of the last 10 years. The price should not be higher than 15 times the average earnings of the past 3 years. And, finally, the price should not be higher than 1.5 times the last reported book value of its assets. Given the thousands of companies who have stocks available on the New York Stock Exchange, picking stocks can be a daunting task for the average individual investor. Any set of investment criteria that identifies one company is likely to identify dozens of others, each with their unique financial situations and context for their numbers. Investors permitting a higher level of risk, who are willing to consider shares in companies that do not meet all of the value investing criteria for the right price, face an even larger selection with no clear guidance of where to focus their efforts. The criteria at least guides investors to the options that have the highest likelihood of returns, removing the worst available choices to ensure that from there, the investor can be confident of having a better than average chance of building a strong portfolio. The next stage of stock picking can focus on an industry that is particularly strong at the moment, like e-commerce, if the investor is particularly confident in that industry. The investor could also seek the best-known brand names in that narrower list, or find the relatively unknown companies more appealing because of their potential to be the next major household name. An investor could practically use an Ouija board to predict success once the companies meeting the chosen criteria have been selected. If the price is within realistic margin of safety limits, those stocks will be predisposed to strong performance in the stock market. Key Insight 8 Corporate accountants have many ways of manipulating figures for losses, taxes, and stock options to show an earnings per share increase where there was none. Investors should be certain to inform themselves of the context behind report numbers. Analysis: depending on how a company reports when losses occur, how regularly those losses occur, when they paid their taxes for recent years, how many stocks they may have in circulation in the near future, the rate of depreciation for their assets, and when they received payments from clients. The numbers on an optimistic-looking comparison of earnings per share may hide dangerous liabilities, undercapitalization, or insufficient cash flows. Companies often hide their worst news at the ends of their reports or in footnotes, so attentive investors should read the entire report to identify the threats that other investors may miss. Accountants working for publicly traded companies have strong incentives to make their earnings look attractive to investors. If they expect to retire soon and make use of their stock options, they benefit greatly by pushing the company's stock prices as high as possible. Standard accounting practices counteract some of these motivations by requiring accountants to use the same depreciation models from year to year, preventing anyone from switching models and suddenly adding value to a depreciating asset. Accounting standards emphasize consistency because so much of company performance is based on year-to-year comparisons. If the accounting methods used between years are not the same, those 2 years are not directly comparable. Unfortunately, accounting standards are such a dry subject that the average investor is unlikely to educate themselves on the topic just to be better able to read annual reports or ask questions at shareholder meetings. The good news is that any significant changes in accounting practices will usually be called out in a report footnote or a dedicated section. Understanding what a change could have been designed to mask may require finding a qualified accountant, but uncovering an unscrupulous accounting practice is within the capabilities of most investors. Key insight: 9 stockholders are part owners of businesses with the ability to change management through their proxy votes, as long as they communicate and organize in their interests. Companies sometimes try to talk them out of dividend payments, which is not in the investor's best interests. Analysis: purchasing a share is all it takes to become an owner of any of hundreds of the largest companies in the United States. Once that happens, a value investor will advocate for their interests with other interested investors. They have the power to remove the company's management if they make unpopular decisions, especially if the managers suggest that shareholders should allow the company to discontinue dividend payments to reinvest those funds into assets. Dividend payments make a stock more attractive, and they generally cost well-capitalized companies very little compared to the gain from investors. Unless a value investor becomes immensely wealthy, they are unlikely to ever be a majority shareholder in a single large company because that would leave few other chances to diversify their portfolio. Still, the investor has a strong motivation to be an active participant in company activities no matter how small the share they own. After all, investing money in a company is taking a tremendous risk and putting a high level of trust in the company management's hands. Those managers decide how that percent of the business is used, and an investor who thinks that their portion of the company has been mismanaged can choose to sell it to someone else. If many shareholders make that decision, the company's market valuation plummets. Both sides of the agreement have an interest in growing the company instead. While management may dislike being told that they are making poor decisions, investors are wise to do so when that is the case. That includes, for example, the instance where one thorough investor finds that an accounting standard change allowed the company to hide a larger than normal tax burden. That investor can bring the issue and the cover-up to the attention of other investors, and they can ensure that their concerns are voiced at the next shareholder meeting. Then, if management refuses to address those concerns, the investors can kick those managers out or take their money and leave. With enough communication between investors, they can have a strong impact on the company and drive it toward better business practices and higher market valuations, a winning scenario for everyone. Author's style: Graham writes in a formal style as opposed to the conversational tone most modern readers are accustomed to. Since Graham's portions of the book were written in 1973 and include large quotations of the 1960s editions of the book, the language can be somewhat dated, using terms some new investors might not be familiar with. Most chapters include jargon-heavy descriptions of the concept at length using hypothetical numbers and generalizations that applied to the market in the 70s but do not apply today, particularly regarding interest rates. Specific guidance on the market for stocks and bonds, case studies that demonstrate principles of value investing, and example analyses are likewise dated. However, the principles themselves are still applicable and thoroughly outlined as well as clarified and outlined by Zweig. Zweig's commentary, written in 2003, has a more approachable tone. It varies from conversational to the style of an engaging lecture. He elaborates on definitions that Graham skipped, although Zweig makes use of plenty of jargon himself. The commentary either provides deeper context for the points made in Graham's portion of the chapter, modernizes the advice, focuses on a topic Graham did not address but which would be valuable to the reader, or discusses a subject which appeared in a previous edition of The Intelligent Investor but which was cut from the 1973 edition. Since Zweig's market insights were written before the 2008 recession, the specific advice and observations are also not totally relevant to today's investment market. Author's perspective: Benjamin Graham wrote his first book just after the 1929 stock market crash. His advice is strongly influenced by his first-hand observation of the dangers of speculative investing and poor money management. As a professor, his principles of value investing were considered in high demand, especially given his firm's success investing in Geico. While defensive investing has waxed and waned in popularity over the years, depending on the level of expertise in the market and the risk that companies took in their financing, some of his students, including Warren Buffett, have become household names in investing. Graham died September 21, 1976. Jason Zweig has written for The Wall Street Journal, Money Magazine, Time Magazine, and CNN.com on the topic of stock market investing. His books promote the same defensive strategies proposed by Graham.